afternoon. Nice to be here, nearer home. I guess I'm like the rest. We're close enough to home now that we don't qualify as experts. When we were down in Medicine Hat and Lethbridge, we were far enough away. My diversification a long time ago when I went farming was that I had my degree and I did really enjoy working with farmers. So I always kept that avenue open and have basically consulted half-time and farmed half-time. And it's been a really good run. I love sitting at the kitchen table. I've been there through probably thousands of consultations. I never tried to count them up, but there's been a lot. I had a chance to teach financial management courses there in the 80s and met a lot of wonderful people. I don't think I see any of them in the room, but they've reported back to me that some of the things we did then were really critical. And so when Rick called me and asked me to talk about transition tactics, I think it was because from their evaluations last year and from the people that they had a focus group on what they wanted covered in this presentation, I think they were talking about transition between generations. And I said, I'm not sure you got the right guy. I'm not an accountant or lawyer. I know there are quite a few techniques. I've got a pretty fair idea what they are. My role usually is to help the families get their information organized so that when they go to those higher priced professionals, they're ready for them and they don't spend so much time finding some of the details that the accountants and lawyers need to help them through. So I think I make it my business to know enough about everything that I know what are the questions that need to be addressed. And unfortunately, that means I don't know enough about anything to be an expert in too much. But I have certainly gained a lot of insight over the years, and I guess that's what I'm going to share with you. I would, first of all, in terms of defining transition, I believe that every time we work with people that are every time we make major decisions, we're basically facing transition. And so that's basically where all my work has been, not necessarily from one generation to the next. But I've got some insights that I think will hopefully help you on that. And I had the talk sort of planned about what I was going to do, and I had sort of a downer topic at the end, and I thought that's no way to leave people. So I'm going to hit it early in the game and then try to get to some of the lighter stuff later on. Now, I have been involved in the cattle industry for quite a while, and I've also had some personal challenges and business challenges and stuff. And this is the personal mantra that I've learned to live by, and I thought I'd share it with you. It certainly applies to what's happened in the cattle industry in the 30 years I was calving cows. I got this mantra from the Dead Dog Cafe on CBC radio, and I don't know how, I hear some chuckles in the room. Other people have heard that program. Genuine Canadian Aboriginal humor. And somewhere I got a certificate with a genuine Aboriginal name, and I forget what it was, Howard Dapple-Hearted something. But they spun a wheel every week to create these genuine names. But they closed and opened the show with this saying, and I think it's pretty sound, and I don't see a lot of humor in it. It's be brave, stay strong, or stay calm, and watch for the signs. And I guess we've done that for probably 30 years, being brave and staying calm part. And I would say that the high calf checks that you've seen in the last 2 years are probably the sign that you've been watching for. Now, in terms of transition between generations, the first thing that I've got to say on the subject is going to lead me into the downer topic, right? A will is not a succession plan. And a lot of people think that if they've got their will together, that's sort of where they stated their values about what they wanted to happen. But the will is for what happens if you die, guys. Transition is what happens if you live. So you just cannot depend on a will. And I'm going to talk a little bit more about that. And I wrote in this slide that the succeeding generation needs certainty. They don't need certainty that they're going to be able to make money. They need certainty that if certain things happen, this is what they'll get. And so you need some kind of a program. And it needs to be ensconced in a solid business arrangement, so that if the succeeding generation does this and this and this, then they're going to have this. It could be, I've seen things where, they gain 10% of the farm per year for 10 years. Or I heard one the other day where they gained 20% of the management, and they had a way of figuring that out every year for 5 years, so that after 5 years, the kids took over and mom and dad stopped managing and just went to being hired hands. So whatever the arrangement is, doesn't matter. It will not work if it's really critical that, actually I would say both generations have certainty. Now the downer topic that I wanted to talk about was dementia. I just actually lucked into it. I went into town one Saturday about 20 years ago and took a workshop put on by the health service about dementia. I didn't have anybody in the family that I knew had it at the time, and I just found it an interesting thing to know about. And as I was sitting there with my consulting hat on listening to them talk about it, I thought, wow, this is profound in terms of its impact on any business succession, whether it's farm or other kind of business, any family business succession, because they described that typically some of the early stages of dementia are paranoia, where they stop trusting the people around them. They think they're out to get them. Another fairly early stage is loss of sound judgment. They start doing silly things and doing things that are out of character and out of, and not making good judgments. Now, isn't that a recipe for disaster if you're in a business arrangement with these? If you're the younger generation and this is starting to happen with one of your parents, and you don't have a solid business arrangement and you're just depending on a will. And then I've had certainly an opportunity to learn more about it in more recent years, and one of the sites that I looked at that had a lot of really sound information on it, and I actually talked to the psychologist about it one time, talk about the loss of capacity that people go through and sort of the stages of it. And so typically the psychologists say there's sort of three kinds of capacity, and one is related to their ability to manage their business affairs. So that's typically the first one to go. And so if you go to a lawyer to draw up a will nowadays, they'll also have you draw up a power of attorney and a personal directive. Well, the power of attorney is the one that's designed to cover that loss of capacity over financial business affairs. The second capacity that typically goes is the capacity to take care of themselves. And anybody that's had family members go through dementia, you find that they lose the ability to properly take care of themselves. They lose the ability eventually to choose food and things like that. That's covered off by the personal directive. But interestingly enough, the last capacity to be lost is what psychologists call testamentary capacity. And that's the ability to form a will, really. And you talk to psychologists and you talk to lawyers and get all kinds of different arguments. And if you ever wind up in court, this thing can go on for years trying to sort it out on an individual basis. But essentially, the test for testamentary capacity is, do you know how many children you have? And do you know that you have assets that are worth something? And do you have some concept of how you might want to spread it out amongst them? So you can see that people could get a long ways down the dementia road. They could have lost capacity to manage their business affairs, and you could have enacted the power of attorney that was in place. They could have lost the ability to manage their personal lives, and you've got the personal directive in place, but they still have perhaps the legal capacity to go to the lawyer and change the will. And they can do it 10 times a day, and certainly there are some who have done it weekly. So that's why a will is not a succession plan. And if a family asks me to come and help them figure out a transitional plan, I make that and understanding at the beginning that we're not doing this to help you write a will. We're doing this to help you form a solid business arrangement that everybody knows about. Now, the other thing that has come up, and I'm not sure if I'm going to get how out of order I'm going to get on my order of presentation, but anyhow, one of the things that some people have talked to me about in the last couple of days is, well, to be honest, the guy used the word DIL proofing. What's DIL proofing? What's DIL? Anybody? Daughter-in-law. It's not far from SIL. There's getting to be a lot of young women going farming now with their parents too, and so there are a number of sons-in-laws around. And so, you know, the older generation wants to know how they can divorce-proof the farm against the DIL or the SIL. And so I guess I've got a couple comments on that. One is that, do you know the rate of divorce amongst people married over 25 years now? It's gaining, it's growing. And so, you know, the kids need as much divorce protection in this agreement as the parents do. So that sits some parents on their posteriors when they think about that. The other thought that I typically would share with people is that I think that if you fully, you know, if you're going to go into business with, you have to decide if you're going to go into business with them or not. And if you are, you should be fully embracing the in-law as you would your child, and treating them fairly and with respect. And if they wind up, you know, if they're contributing to the business, they've got to be protected too. And I would think that the more that you respect and care for them, the greater the chance that there's not going to be divorce. So that's what I've got to say on that subject. And that's part of that whole certainty thing. Now, when you're setting up these business arrangements, the hardest clause to get the families to work on is the most important clause. And that's the dissolution clause. Like, how do we pull this thing apart if things aren't working? And that's the hardest one to come up with, and you're going to have to spend a lot of time thinking about it. But that is where the certainty comes, is you all know that if things don't work out, this is how we get out of it. And you can do things in there that mean that if one person in the family in the arrangement dies or wants to leave, that there's a way to buy them out over time that the rest of the business can afford. So you need to have that plan. There are a wide variety of arrangements possible for transition. I personally wind up having people seriously consider incorporation most of the time, simply because it provides so much flexibility down the road. It is not for the faint of heart, because it's a totally different way of operating. You know, you have to get your head around a different way of operating, but it certainly gives you a great deal of flexibility in terms of how you build the business and share things down the road. The other thing that I caution farm families against is sharing arrangements, like keeping the cows in the herd. You have a quarter, you know, having somebody with a quarter section of land, or we get into some terribly convoluted machinery sharing arrangements sometimes where there's 2 or 3 or 4 people involved in the farm, and A and B have a half share in this outfit, and C and B, C, and D have a third each in this one, and it gets pretty crazy sometimes. But and especially the crop farmers, where they've got a quarter or two in the kids' names, and they get the production off of it, or you've got cows in the herd, or whatever the arrangement is. If the idea here is to build this family farm, I think that you should be working as a team towards the greater good of the whole. And I think a company gives you that vehicle more than many other arrangements do. And certainly sharing arrangements often pull you apart, because sometimes what's best for your cows isn't what's best for their cows, or what's best for this quarter isn't what's best for this quarter. And you know, that's been my coaching to families when they wanted my opinion. That you're better to be trying to put this thing together as a whole and have everybody working towards the benefit of the whole. And surely the whole should be greater than the sum of the parts. Now, the other element of transitional planning that I think gets pretty short shrift is the focus on financial understanding. I was pretty excited to hear there was going to be quite a contingent of college students here. I don't think there's too many of you left. But I think that this is absolutely critical, that you understand finances very well in running a farm. And I'll talk more about this as we go. Earned financial progress is what pays for it, and I know there's a lot of balance sheets on farms that look really good. People have a lot of equity, but much of that equity is there because of the increase in value of land, and it's not because they were actually earning money on the farm. And if you're going to go ahead bringing in another generation, you have to know how much have we been earning and how much are we likely to earn. And then the other thing you have to know, and I'm not sure what order my slides are in. No. The other thing you have to know is, oh, I've got it there, is how much do we need for living costs for each of these families, because it's got to be affordable. So we've got to know how to calculate what we're actually earning, and we've got to know how much we have to earn to live. The other little issue, the other not uncommon issue, and it's more common on ranches than others, than perhaps grain farms sometimes, is the legacy issue. You know, and now we've got a lot of 100-year farms around in central Alberta, and that's quite a burden to carry, to try to keep this place going with grandpa's and great-grandpa's legacy. I have, you know, there are some other things you can do to sidestep legacy. You want to address legacy so that you can sidestep it in your business decisions, so you can go on and make proper business decisions and not always be worrying about trying to keep this thing going in the manner to which Grandpa had it or Dad had it going. And there aren't many farms that don't have somebody to transition to. So, you know, if you want to keep legacy, if you want to keep it going, you're going to have to make a relationship with somebody else. And you're going to have to probably give them a leg up. Now, if we're talking $2,600 or $3,000 cows, and the bank says that you've got to have a minimum of 25 or 30 or 40% equity, young people coming out of college aren't going to have that. So talk about barriers to entry. Like in 2014, the barrier to entry on a farm, on a beef farm, is just about as bad as trying to get going on a dairy farm. So, you know, you've got to figure out how these young people are going to, if they're going to follow a traditional model of ownership, how they're going to get that. And somewhere you may have to, the older generation has to contemplate how much they're willing to share of their equity to give the next generation, whether it be in their own family or not, a leg up. So I sort of see the core word there is leg, legacy, leg up. I did see a family fairly close to me in a non-farm business do something neat on the legacy issue a year or so ago. They formed scholarships in mom and dad's names at colleges that had programs that represented things that were important or values that were important to mom and dad, and put some money over there to fund those scholarships, and then now they're free to manage the company how they want. And if somebody comes along, it was not a farm company, and if somebody comes along and wants to buy that company out, they're free to sell it, and they've sort of addressed the legacy in a really quite a beautiful way. And of course, in the ranching world, a number of ranches have done things like conservancies, and we saw an issue here a situation a couple years ago where a very large ranch in southern Alberta was donated to the University of Alberta. There's a fairly substantial farm north of Edmonton there near St. Albert that did the same thing. So, you know, I'm not sure what the thing is, but I'm just sort of trying to get your head going on the fact that you may be able to address legacy in some other way than by keeping things going in the way to which Dad and Grandpa did things. My vision of management of any business is that there are sort of four key elements to it: production, marketing, human resources, finance, and administration. And really, you've had talks today on the top three, and I'm down here on the fourth one. And I'm just going to talk a little bit about some of the financial stuff that I think you need to know. So the three standard financial statements that every business should have at least every year, and possibly every month or quarter or semi-annually, are an accrual income statement, a balance sheet, and a cash flow summary. And I know there are some incorporated farms in the province of Alberta, and there are probably some in this room that are incorporated, and I know that you get proper balance sheets and income statements every year when you file your income taxes. So you've got some of this stuff. And some of you get cash flow summaries and some of you don't. Notice to reader statements typically don't have them, and the next level up do, but sometimes the accountants will still print them for you. So you've got some idea of the information, and I'm going to talk about the information we need out of each of these. But for those farms that are not incorporated, the typical thing that I see when I'm doing consultations, and that is that you filed your income tax, you scrambled to get the stuff into the accountant in March and April. You get in there in the end of April or early May to find out how much you get back or how much you owe. And you've got a farm income tax statement, a record of farm income and expenses that takes up typically 5 pages of that 40 or 50 page mass that you get. And you don't really know how much money you made last year as a result of that. And if you do look at it, it doesn't tell you anything. They've got other stuff. They've got right now everybody's using these T1163s, so on page 1 the incomes are split into 3 different categories. And then page 2 you've got 2 different kinds of expenses, eligible and ineligible. And hiding in some of those are your optional inventory adjustment, your mandatory inventory adjustment, and your capital cost allowance. And if you're on a dairy or some other farms, they've got another one in there. And so you look at that and it doesn't tell you anything. So typically the first 20 minutes I'm on a consultation, we're taking that income tax statement. We look at, most of you now have year-end records of inventories and payables and receivables because you're involved in ag stability. And so if we can get those records ready and I get there, it takes about 20 minutes to convert that tax statement to a proper accrual income statement that tells you your earned financial progress. And that is the key thing for which you should be making your management decisions off of. And the thing that I've noticed over the years is that the farmers that really understand what creates accrual income are the people who make the most effective management decisions. The cash flow summary is important because in there it tells us how much non-deductible expenses we had. Remember, you guys all know on the income statement, you've only got your deductible expenses. But there are a bunch of cash flow items that go out every year that are not deductible, and and they basically fall into 2 categories: principal and personal living costs or household expenses. So the vast majority of the farms that I've been on do not have a clue of what their household expenses are, or their owner's withdrawals or living costs or whatever you want to call it. There's different names for it, and they're not always just household expenses, but they're owners with, probably a better name is owners' withdrawals out of the business. And so remember I said at the beginning, an important element of transition is having enough money for both families and knowing what both families are spending. So So from a source no less reliable than Rick DeHaad of Alberta Agriculture, who put out a newsletter a year or so ago, news release, he had some Statistics Canada expense information for household expenses. So I picked out 4 of the numbers that I thought I could work with for this presentation, keep things simple. So all of Alberta, if we looked at all of Alberta, typical household expenses or average household expenses in 2009 were $66,000. In 2010, we're almost 69. In 11, $71,500. Now, rural Alberta, that's outside of cities and towns, is about 53,000, which coincidentally is very close to 80% of the city, of all of Alberta. So I said, well, how do we figure out what farmers or rural people are spending in 2010 and 11? I just said, well, it must be about 80% of the all Alberta numbers. I imagine the proportion stays the same. And I said, well, yeah, but we're not talking about 11 anymore. That's like, we're looking at projections now for 15, 16. So I said, well, that was a 4.3% increase from 09 to 010 and another 3.9 to 010 to 11. So looking forward when we're doing projections, I do a lot of the shopping in our family, and I'll tell you, I have a hard time to believe that inflation's only at that amount. I see everything we buy is in smaller packages now, and we're paying more for it. So I think that it's a pretty reasonable assumption that our living expenses will be up about 20% from these levels, and so that gives us sort of the estimate. So rural Alberta would be upwards of 69, in that $69,000 range as average living expenses. And typically when I ask people what are your living expenses on the farm, they think about groceries and not too much more. If somebody's standing there smoking a pack a day, I can sort of usually chide them into admitting what that's costing. But people have a hard time getting their head around what all goes into household expenses. So what I did next is we had the breakdown for that number there, for that number for 2011, and so I just took that 2015 all Alberta number and broke it down because it gave us some categories to talk about and give you some idea what the average is. So the top 7, there's 14 categories. I put 7 on each slide. So the top 7 in order were shelter, transportation, food, personal insurance and pension, recreation, household operation, and clothing. And Rick had pointed out in his news release that the one major difference between rural and urban was the shelter, because urban people tend to have to pay more for for town lots, and they've got mortgages on their houses more and that kind of thing. And I would argue that I suspect rural people probably pay more for transportation, but most of it's hidden in farm expenses. So that's not showing there. But in the next page are the 7 smaller categories. So we've got gifts and contributions, household furnishings, healthcare, miscellaneous, fun, and reading and education. Now, isn't that interesting? Reading and education together are less than drugs and alcohol and gambling. And there are a number of families in central Alberta that strongly support their churches, so gifts and contributions often are much larger than that. And there are a number of families in central Alberta, often the same families, that have their children going to church schools, and so they're paying an awful lot more there. So at the end of the day, I wouldn't be surprised that these numbers aren't too far off for a lot of farms. But I think the important thing is that you see the list and that you know what yours are. Now, what's the consequence of this? Personal living expenses and principal reduction are all paid for with after-tax dollars. And after-tax dollars are not easily come by. If you're down in the bottom tax range, which is up to about $44,000 of taxable income, you only pay 25% interest or income tax. And if you're a 2-adult family, the first $25,000 that you earn is basically personal deductions. So this would be the next $44,000 after that. And you can see how the rates go up as things increase. And the reason I put this slide in was because I've had, the 55 plus year old cow-calf owners talking to me and saying, you know, we've been through a lot in the last 30 years, and with these cow prices, I'm sure like to send the cows into some of those December cow sales, but I've talked to my accountant, and they tell me that I'm going to have to send 40% of it to Ottawa. And so I've got some insights here for you on that. Now, I just wanted you to look at that table flipped a little, or another way. This is how I usually show it to people to get their attention on the farm, is that if you're in that bottom tax range of only 25% tax, you have to earn $13,300 to have 10 left over. It's simple arithmetic. 25% of 13,333 is 333, and that leaves you 10,000. So it's pretty simple arithmetic. So the number you want to be remembering is that number there. How much do you have to earn to have $10,000 after tax to use for living and principal reduction? Well, if you get in the next tax bracket, it moves from 13.3 to 14.7. Next tax bracket, 15.6. Anybody want to guess at 39% what that number is going to be? Fast arithmetic in the crowd? Over 16. So if you're, let's say your living expenses are $60,000. Say 55 for easy figuring, because you can take off 25 for personal, so that means you only had to have 30,000 after-tax money for living, and you also want to get some debt paid down, so you want at least 30,000 to go to debt retirement every year. That means you have to, at a minimum, be in the second category. And 30,000 after tax for living and 30,000 for debt reduction is a pretty minimal level for most farms. And so that would mean you needed $60,000, so you have to multiply 6 times this, which is basically $90,000 of net revenue in order to have $60,000 available. So what happens if the farm is incorporated? Things change a bit. You've got your first $500,000 of ordinary income is taxed at a 14% rate, and over that it's at the same rate that's the lowest personal tax. So if we do the same arithmetic here, instead of having to earn 13,333 in the bottom tax category, or 16.9 or 16.3, whatever that number was, now you only have to have 11.7 or 11.8 to have 10,000 left over. So if you're trying to pay off principal and take living out, if you could get yourself into this category, wouldn't that work a lot better? Yeah. So what I've got now for you is a little known maneuver that is going to be of benefit to some of the people in this room. If you're already incorporated and the cattle and equipment are already in the company, this does not apply to you. It's not going to help you. If you file income tax as a proprietorship, as a single proprietorship, typically dad files the farm tax, and sometimes it's split with, the husband files it and it's split with the wife, and sometimes it isn't. And writing a check to her for wages isn't. So if you are filing your tax as a partnership, if you're seen as an established partnership, that's the key element. Have you been filing your tax as partners? And so if you look at that farm income form, income statement on your tax, that way back in the 40 pages, that 5 pages I talked about, at the last of the 5 pages, it says what percentage of this income is yours and what percentage goes to somebody else. If you've been splitting it up, you are an established farm partnership in the eyes of Revenue Canada. So I've got something for you if you're in that boat. If you're a single proprietor and you're not in that boat and you want to get in that boat, you've got to get talking to your accountants pretty soon to see what you can do to switch from being a single proprietor to a partner so you can take advantage of this maneuver I'm going to show you. I'm going to tell you right now that there are accountants and lawyers that you may be using that are not familiar with this. And they may tell you that what I told you was wrong. But I'll be honest, my wife and I did this ourselves in 2000. I've been through the process, and the steps I'm showing you are exactly the way we were worked through it. Now it's a minefield because there's lots of other things that have to be thought of, and you have to have really good help to get through this. And I'm not the guy to help you through it, but I'm here to tell you that the process is there and it's available, and it can have a profound impact on how much money you can get out of the operation for living and for principal reduction. And I think that has a profound impact on your ability to bring in another generation. So the first thing that you do is that you form a company, or perhaps you've got a company already for another business and you want to use it. Doesn't matter. You've got a company that you have. Typically, husband and wife both own all the shares in this company. That would be the typical arrangement. It may be a brand new empty company. It has no assets or anything. That would be the example I work off of. That's the way we did it. We formed the company in February, and then the company bought my wife's partnership interest on May 31st. And then the company farmed in partnership with her for a month. And then on June 30th, the company bought my partnership interest. And then on July 1st, as managers of the company, we said, and it was already pre-planned, we said, well, now we own the whole partnership, we don't need it, and we dissolved it. And now the company owned the assets and took on the assets and the liabilities and had all the privileges and responsibilities of the partnership, but the partnership existed no more. Now, how did the company pay us for that? Because it had no money. It was empty. Shareholders' loans. So John got a shareholder's loan for so many dollars. Donna got a shareholder's loan for so many dollars. So there's the key. That shareholder's loan is principal that I loan to the company. And principal's not a tax-deductible expense, right? So when the company pays me anything back on that shareholder's loan, and it could be $10 or it could be $10,000 or whatever at a time, whenever the company pays me anything on that shareholder's loan, the company cannot take it as a deduction. But that's okay, because it's only costing the company 14% to not take it as a deduction. And I don't have to show it as income anywhere because it's repayment of principal, and principal is not a taxable revenue. So now you only have to earn $11,700 for every 10 that you want to take out. And if your cows, if your cows all got turned in there, and you've got 100 cows that are worth, what are 100 cows worth now? Say $250,000. That you would have had to pay 39% tax on. Now you only have to pay 14% because that's under $500,000. You could take it all out right away. So you need. As I say, there are many other issues. People have asked me about grazing leases. I got a definitive answer from Sustainable Resources this morning. I unfortunately never had it for Lethbridge and Medicine Hat talks because, and there's a lot of grazing leases in those countries, in that part of the country. But the definitive answer from Sustainable Resources is, if you want to keep the grazing lease in your personal name, but you put the cows in the company, and the brand goes with the cows, right? You have to transfer the brand into the company too, or else when you sell it, you can't get the funds. So you know, your cows and your brand go into the company, but you maybe want to keep the lease out of the company. So can you do that? Because now you got company cows running on your lease. And you can't do that, right? They've got to be your cows. So yeah, there is a form. You apply to Sustainable Resources. You say we want to put other cattle on the lease, other livestock on the lease, and you provide them some documentation and fill out a small form She said it just takes a minute to fill it out, and you say, basically we are the shareholders that own this company, and we own these cows, and they're the same cows and the same brand, but we want to run them on the lease and keep the lease in our name. And she said, she can't process it at her level in Rocky Mountain House, but she can send it up to headquarters, and it's typically a rubber stamp. So that's how that's how you address the grazing lease issue. And you talk about flexibility of companies. That's some of the flexibilities. You can buy another company and merge it into yours. I had some clients one time who had a fiscal year end of, I forget, September 30th or something, right in the middle of harvest, and they said, "Geez, we got to change this fiscal year end." And I know, they were selling. There's another reason. They were selling something that's going to have a huge tax liability, and they wanted to put it off for a year and figure out a way around it. So they needed to change their fiscal year end. And you can't write Revenue Canada and say, we want to change our fiscal year end because we want to save tax. They won't let you do that. You have to have a sound business reason to do it. So A, you can figure out another sound business reason to do it and write them and beg and ask them to change your fiscal year end. Or B, you can buy another company with a different fiscal year end. You merge the two companies, and then you have to choose the fiscal year end of one of those companies. So I mean, for them, it was actually worth buying another off-the-shelf company with a different fiscal year end, and then merging it, taking their year end, and never using it. So you get all that kind of thing. The other thing that really works nicely for transitional planning is estate freezes. So mom and dad have all this equity in the company, and they have all the common shares. And then you say, well, let's just convert those commons to preferred shares. So now the company owes mom and dad so many dollars for those preferred shares. And then we issue a whole bunch of new common shares. And mom and dad and son and daughter-in-law all each have 25% of the new commons, and they continue on. And any growth in the company now is shared. The growth is shared 4 ways or 3 ways, whatever whatever you want it. So you've got all that flexibility, and then you've got everybody. And typically they'll set it up on these small family partnership or companies. They'll set it up with a myriad of shares, A, B, C, D, E, F, G, and so John will have A shares and Donna has B shares. But if our kids came in, they'd be C and D and E and F shares, that kind of thing. So that you might wind up declaring the dividend on Class F shares, but not on anything else, or different dividends on different shares. Or if you've got huge shareholders' loans sitting in this thing, you ain't going to be declaring dividends because you can take out most of the money you need without paying any more tax on it. Because they've got the tax laws basically set up so that if you are taking out wages or dividends from a company and you're spending $80,000 a year on living expenses, they're going to tax you as though you're spending $80,000 a year on living expenses. They've got the different ways of coming around and getting it. But if you take it out the way I've showed you, that's what you pay. And that's critical, and that's really important for being able to afford to pay down debt to people without having to sell your land. Because, typical when people try to pay down debt, they can't do it without the tax consequences of selling cattle and equipment to pay down debt are such that if people really want to make a big amount of debt, they usually have to sell some land. To have land's usually the most effective asset to sell, and of course, who wants to do that, right? So this, and there are many accountants who are not familiar with this, and so I want to emphasize to you that the key element here is that you are transferring the partnership interests, not the assets of the partnership. That is absolutely key. If you write down one thing, that's what you've got to make sure that your people understand. And in our case, we went to a very good farm income tax specialist lawyer, and the lawyer led us through the process, and the lawyer basically instructed the accountant how to, what they had to do. So that's the key right there, is that you're doing partnership interests, not assets.
You said your partnership was cattle, your company was buying the cattle. Is that...
No, the company's not buying the cattle. The company's buying the partnership interests. The partnership owns the cattle. It's just like buying shares, but it's called a partnership interest.
But the company gets the brand on the cows, right?
Well, after the company owns, after the partnership's dissolved and the company now owns the assets, because then the company goes to the regulatory services and said, now, John and Donna apply to regulatory services and say, we want to move our brand over to Solar Harvest Ventures. Yeah.
So the company would pay the partnership one-fifth every 5 years until they own the cows. Is that how it would work?
Oh no. You see, you're making that elementary mistake that some of the accountants that have listened to me talk have made too. Because they're thinking that the company is buying the assets. You're talking about the company buying the cows. The company is not buying the cows. The company is buying your partnership interest. And your partnership happens to own the cows. And so it's just like buying that company and merging it. It's just like buying that company and merging it and then getting rid of it. Question at the back? What I'm talking about is just for the people in the room that are partnership, and the cows and typically machinery are in the partnership. If they're already in a company, it's too late. This isn't available. Well, let's say that I wouldn't shy away from it. You've got to do your due diligence. I mean, you've got to go to a lawyer and make sure that the agreement to purchase is done properly, because when you buy that company, you are taking over you are assuming the liabilities that may accrue to that company. So if they had for instance, had an employee have an accident last year, and he comes and sues them this year, and now you own the company, you're on the hook. So you've got to make sure that you're protected against any past liability from that company. I'm not an accountant, and you're getting into some sophisticated stuff, but if it was me, I would seriously look at mitigating the risk on that, on the liability. And I know it can be done because I've got friends that did this. They bought a complete farm, and it was fully incorporated. They bought everything, and that's how they did it. The lawyer just went through some steps to ensure that any liabilities went back to the old shareholders. And the old shareholders, I'm not sure how they did that, but it's possible. And then you buy that company and you just merge it. I don't know how to merge this stuff. I'm not, you need a good lawyer to help you through that. Yeah, okay, so that was my point. If you're in that boat, I don't think you can afford to procrastinate. You have to go learn more about this. They have to be coordinated. The question is, does a will override a succession plan? It won't override a good business. Like, they have to be coordinated. But you want your business plan set up so that it cannot be scuttled by a will change. Okay? You need solid business arrangements. Well, the one thing I like the whole thing about commons and preferreds, and that is that, like, you can do a corporate freeze multiple times too. So let's say we did it the way I said, where you had your mom and dad are still wanting to stay active in the business, and so we wind up with new common shares, and we now have 3 or 4 people all with common shares, and then 5-10 years down the road, mom and dad say, no, we want out. Well, you just do another freeze and turn those into preferreds, and have an arrangement to buy them out over time, so much % per year at a certain percentage. Another scenario is that child number 1 comes into the family and we do an estate freeze, and then a few years later child number 2 wants in. The farm's growing and we've got another member wanting in, do another estate freeze. Child number 1's part of that. Child number 1 might get their shares turned into preferreds too. You just got so much flexibility. And in terms of, land in companies, people are worried about land in companies. Well, I don't see the worry as long as you can control the land, and there's always ways to butterfly the company and put a piece of land in a particular company and put somebody's name on it. And so they maybe don't have their own name on the land, but they have the name on the company that owns the land. They own all the shares. So I just don't see a lot of The common concerns people have about them, I just don't share them typically.